In this chapter, we're going to finally get to the fun stuff and start talking about option strategies that you can use to start making money trading options. And this chapter is going to be dedicated to teaching you the ins and outs of trading single options, the most basic way to trade them. Specifically, we're going to cover the ins and outs of buying an option, and we refer to this as a long option, and then we're going to teach you about selling an option. We refer to this as a short option. First, let's talk about the long option. We're going to talk about buying a call option. There are two reasons someone might buy a call option. First, for whatever reason, you think the stock is going to go up soon. Now, the reason you would trade the call option instead of just buying stock is because it would allow you to make this bullish bet for much cheaper than it would cost to buy the stock. And because you can buy a call option for much cheaper, you can achieve a much higher return on your capital than if you were to instead buy the stock. Let's take a look at some real option prices. You can see the call option prices on TLT. These options have 31 days to expiration. So let's just take note of the stock price. The stock is currently at $121.91, and actually we'll just call it $122 to keep it simple. Then we're going to take note of a few of these options and the prices. If we look at the mark price of these options, which is simply just the mid price between the bid and the ask, you can see the 121 strike call is at 264, the 122 strike call is at 210, the 123 strike call is at 168, and so on. Now, let's just look at one hypothetical scenario and then compare the returns that each of these options would have provided to the returns that the stock would have provided. Let's say the stock goes from 122 up to 130. If you bought the stock at 122 and sold at 130, then you made $8 per share. So a profit of $8 per share divided by your entry price of 122 means you made a percentage return on your investment of 6.6%. Not bad, but let's compare that to the returns that these call options would have provided. Now, the first strike we're looking at is the 121 strike call option. This option is slightly in the money, and the option was originally at 264. But if the stock went up and is now at 130, then this call option will be worth its intrinsic value, which is $9 per contract. You learned about this in Chapter 3. So if you were to buy this option at 264 and sell it at 9, then that would have made you a profit of $636 per contract. And if you made a profit of $636, but you only paid $264, then your percentage return on capital was a whopping 240.9%. Now, let's do the same thing for the other strike call options. And I just went through the calculation with you on this strike, so I'm not going to go through that whole process for all of the others. We're just going to put the numbers up on the screen for you to see. You can see that some of these strikes provided a much bigger return than others. And you can see that the 125 strike even provided over a 400% return on your money. If you traded one contract, you could have turned $97 into $500. 10 contracts, you would have turned $970 into $5,000. And if you're a high roller and traded 100 contracts, you could have turned a $9.7 thousand investment into $50,000 in just 31 days. This is the exact reason someone might buy a call option rather than buying the stock. It simply provides leverage to make big profits with very little capital. This is the main reason for showing you this demonstration. The second reason I show you this demonstration is to talk about strike selection when buying options. You can see that the cheaper out-of-the-money options provided a bigger percentage return, and the more expensive in-the-money options provided a smaller percentage return. So you might be thinking, why wouldn't I always just buy the out-of-the-money options if they're cheaper and also provide a better percentage return? Well, there's a trade-off for this. The further out of the money an option is, the lower your probability will be of making any money on the trade. We call this your probability of profit, or POP for short. Let me explain. Let's calculate the break-even point for each of these. The break-even point is simply the price we need the stock to be at least break even on the trade. So first, for the stock, our break even is simply just the entry price, right? If we bought the stock at 122, then we would just need the stock to be higher than 122 for us to make money. So our break even for the stock is 122. Now let's calculate the break even point for this 121 strike call option. To find your break even, you're simply going to add the price you pay for the option to the strike price of the option. So in this case, your break even would be our entry price of 264 plus the strike price of 121, and that equals 123.64, which is our break even. So go ahead and write down that formula in your notes for finding the break even price when buying a call option. And whatever that break even price is, you need the stock to be above that price at expiration for you to make money. Now we're going to do this simple calculation for all the other strikes as well, but again, we're just going to skip ahead and put the numbers up on the screen for you to see. You can see that the further out of the money options that provided a bigger percentage return had a worse break-even point. So if the stock has to make a very big move for you to even make a penny on the trade, then that means you're going to have a very poor probability of profit because it's unlikely for the stock to make that large of a move. So to sum it up, you can see that the larger potential payout is accompanied by a poor probability of profit. So that's where strike selection comes into play. When buying a call option, choosing a further out of the money strike will result in a larger potential payout because the options are much cheaper, but in turn it will also result in a very low probability of profit. And a further in the money option will have a smaller potential payout, but it will have a higher probability of profit than the out of the money options. Now with that being said, let's actually go through the process of buying a call option so you can see how it works for yourself. Right now, you're looking at a chart of Facebook's stock price. Let's say that for whatever reason, we think the stock price is going to go higher soon. Instead of buying the stock, let's buy a call option. If we go to the option chain, we can find an option to trade. We just have to select our expiration and also the strike price. First, let's choose our expiration date of the option we want to trade. Let's use what you learned about option Greeks in the last chapter to talk about the pros and cons of certain expiration dates. So let's just look at two of these expiration dates and then compare. We're going to view the options with 4 days to expiration and then also the options with 60 days to expiration. You can see that the theta is much higher on the options that have fewer days left to expiration, which means that time decay will be hurting us a lot more. But at the same time, you can see that the gamma is also much higher. The higher gamma is good for option buyers because it means that you can make faster profits if things go in your favor, but the trade-off is that the much higher theta means we are losing more money to time decay, so we would have much less room for error if we don't time the entry perfectly. So let's just find a happy medium and choose the expiration cycle with 25 days to expiration. Now we just have to choose our strike price of the option we want to trade. Remember, choosing a further in the money option will cost more money and therefore provide a smaller return. Also, buying a further in the money will mean that you won't be fighting time decay as much because there is more intrinsic value and less extrinsic value on a deep in the money option. Now, an out of the money option would be cheaper and have a bigger potential return, but at the same time would cause us to have a very poor probability of profit. So just like with choosing your expiration, there are also pros and cons to choosing different strikes. So again, let's just meet in the middle and buy the at the money option with the strike price of 122. To do this on the Thinkorswim platform, all we have to do is right-click the option, then click Buy, Single. Now you can see the details of the order to buy this option. You can adjust the price you want to submit the order at, you can adjust the number of contracts you want to trade. For this example, we're going to just say we want to trade one contract at 262. If we click the Confirm and Send button, you can see a few different details about this trade. First, let's look at the cost of the trade. You can see that this trade will cost us $262 plus any commissions our broker charges. So the total cost of the trade is $263. Now let's talk about our risk. Our risk when buying an option is simply the same as our cost of the trade. We can only lose the amount we pay for the option because the option can't go below zero. If the option ends up being worthless, then we will simply lose the money we paid for the option. Just keep in mind that the max loss and max profit numbers displayed in this order confirmation box does not factor in commissions. Now for the buying power effect. The buying power effect is simply another name for your capital requirement on the trade. You can see that the capital required for this trade is $263. This is obvious really for buying options, but this will come in handy quite a bit when we talk about our next strategy, which is selling options. Now, moving on up to where it says maximum profit, you can see the max profit says infinite. This is because theoretically a stock has no cap on how high it can go. So therefore a call option is considered to have infinite profit potential. But guys, this is theoretical. Have you ever seen a stock go to infinity? Me either. I think a better word for this would be undefined. So your max profit is undefined when buying a call option. Now let's check out the break-even stock price and talk about what this means. You can see that on this trade, the break-even stock price is $124.62. This is simply telling us that if the stock is at $124.62 at expiration, then we will break even on the trade. In other words, this tells us that if the stock is above this level, we will make money on the trade, and if the stock is below this level, we will lose money on the trade. The way this is calculated is by simply adding the entry price that we paid for the option to the strike price of the option. So in this case, the strike price is $122 plus the price of the option, which was $262, so the break even on the trade is $124.62. Earlier, we briefly touched on the fact that probability of profit of a trade is tied to the break even of the trade. The cool thing about options is we can see exactly what our probability of profit is. If we make money when the stock is above our break even point and lose money when the stock is below that point, then all we need to do is figure out the probability of the stock being above that break even point, and that would allow us to know our probability of profit. Let me quickly show you how to find this. Let's exit out of this order confirmation box, and then we're going to right click anywhere on the order and then click Analyze Trade. This graph is called a risk profile. The risk profile is used to give us a visual of exactly what our profits or losses will be on a trade based on where the stock price is. So let me quickly explain how to read this risk profile. The x-axis is the stock price, and the y-axis is the profit or loss of the trade. So if we pick a point at which the stock price is at, that will tell us what our profit or loss will be on the trade. And we're focused on the blue line here. We don't care about the purple one for now. The blue line shows us our profit or loss based on where the stock price is at the expiration date. So for this strategy, you can see that if the stock price is at $130, for example, then this trade will have a profit of just over $500. Now, you can see that the blue line flattens out when the stock price is anywhere below $122. This is because the long call strategy can only lose so much money. If the stock is anywhere below our strike price of $122, then this trade will be at its max loss of $262. Now, you can also see that if the stock continues to go higher and higher, our profits will get bigger and bigger. So basically, anywhere the blue line is above the zero line, that means that you have profits, and anywhere the blue line is below the zero line, then that means you will have a loss on the trade. So where this blue line crosses the zero line, that's where our break-even point is on the trade. Now, the main reason I show you all of this is to show you how to find your probability of profit if we were to buy this call option. Now, you can see the probability of the stock being above this break-even point is 34.57%. So therefore, your probability of profit is 34.57%. Or in other words, we have a 34.57% chance of this trade being a winning trade at expiration. On the flip side, you can see the probability of the stock staying below our break-even point is 65.43%. This means that the probability of losing money on this trade is 65.43%. When buying an option, you will never have a probability of profit better than 50%. But that's okay because we're about to show you much better strategies anyways. So let's recap. A long call is a bullish strategy where we want the underlying stock price to go higher. Time decay is against us, so we'd really be hoping for a fast move of the stock so time decay doesn't hurt us too much. And we'd also benefit from an increase in implied volatility. Our max profit is undefined because theoretically a stock can go to infinity, so as the stock goes higher and higher, we will make more and more money. And the max loss is simply the price we pay for the option. Since an option contract can't go below zero, then we can't lose more than what we purchased the option for. And you can also see this illustrated in the risk profile in the top right of your screen. And the break-even price is simply the strike price plus the entry price of the option. If the stock is above this point at expiration, then we will have a profit, and if it's below this point at expiration, then we will have a loss. If you decide to trade this strategy, just keep in mind that choosing a further in-the-money strike will provide you with a better probability of profit, and choosing a further out-of-the-money strike will give you a better potential percentage return. So, alright guys, that's it for the long call strategy. Now let's talk about the long put strategy, where we would buy a put option. Buying a put option is the exact same concept as buying a call option, except instead of betting that the stock will go up, you're betting that the stock will go down. So buying a put option is a bearish strategy. That's the only difference. Time decay will still be against us, and we're still hoping for an increase in implied volatility. But since this is a bearish strategy, the risk profile is going to look a little bit different. Basically, it will just be reversed. As the stock goes lower and lower, you will make more and more money. And if the stock price is above the strike price, meaning your put option is out of the money, then you will lose the entire amount that you paid for the option. Now, for the break-even point, the calculation is slightly different. For the long call, the break-even point is calculated by adding the entry price to the strike price. But for the long put, your break-even is calculated by subtracting your entry price from the strike price. If the stock price is below this break-even point, then you will make money, and if the stock price is above this break-even point, then you will lose money. So that's really all there is to buying a call or a put option. But before we move on, let's talk about expiration. At the expiration date, if your call or put option that you own is in the money, then you're definitely going to want to close the option position before it expires. You would do this by simply selling the option that you own. If you don't close it, then it will turn into stock. Holding an in-the-money call option through expiration would turn into long stock, and holding an in-the-money put option through expiration would turn into short stock. Most option traders prefer to avoid this because the stock position would require much more capital. Now, if for some reason you do want to own the stock, then you can do one of two things. Number one, you can hold the in-the-money option through expiration and it will turn into stock. Number two, you could sell the call option and then buy the stock at the current market price. Both achieve the exact same thing. Let me show you why. Let's say that stock XYZ is trading at $130 per share, and you own the 120 strike call option at 4. You could let the option turn into stock and you'd now own the stock at the strike price of 120. So you'd be up $10 per share on the stock position. But you paid $4 for the option. So really, you have a net profit of 6 points. Now, instead of doing this, let's say we just sold the call option and then bought stock at the current market price. We'd be able to sell the option for 10 because it's 10 points in the money. And since we bought the option at 4 and sold it at 10, we made a profit of 6 points on the option. and we'd own stock at the current market price of $130. So we'd be at break even on the stock. So in this case, we'd still have a net profit of 6 points. Now, the reason I show you this is to show you that there really is no benefit of doing either. The pricing is always going to be fair anyways, so it's really all the same. Now again, most of you aren't going to want to have the stock position. So just close the option before expiration if it's in the money. Now, if the option is out of the money and is worthless, then you don't need to close it in this case. You could just let the option expire, and of course you lost the amount you paid for the option, but it will expire and disappear from your account. It won't turn into stock. The only way it will turn into stock is if it's in the money. So, alright guys, hope you enjoyed the video. If you did, make sure to click the like and subscribe button below. And also, be sure to check out our 3 free video series by clicking the link in the video description below. These videos will help your trading tremendously, and they are completely free. All you have to do is click the link, input your email, and we will send you the 3 videos. So, I will see you there.